Your rent went up, your groceries cost more, your salary barely moved, and somewhere, someone made money from the very thing that hurt you. This isn't a conspiracy, it's a transfer. The largest peacetime wealth redistribution in modern history, and it's happening in plain sight while economists debate whether inflation is transitory or sticky. As if the terminology matters to you, here's what they don't tell you about inflation. It's not just prices going up, it's a mechanism. And like any mechanism, it has winners and losers built into its design. Let's start with what actually happened. Between 2020 and 2023, the United States printed more money than it had in the previous 2 decades combined. Trillions in stimulus, liquidity injections, asset purchases. The M2 money supply, that's the actual amount of dollars in circulation, jumped 40% in under 2 years. 40%. That's not inflation, that's the prelude. The inflation itself came later. When all that new money started chasing the same amount of goods and services, prices adjusted. Your rent didn't go up because your landlord got greedy. It went up because the value of the dollar fell and the rental market repriced itself accordingly. Same apartment, more dollars required. Now, here's where it gets interesting. Not everyone experienced this the same way. If you held cash, you got quietly poorer. Every dollar in your savings account lost roughly 15 to 20% of its purchasing power over 3 years. If you had debt, especially fixed rate debt, you just got a gift. The money you owe is still the same number, but that number is worth less. You're repaying your mortgage in cheaper dollars. But if you owned assets, real assets, things like real estate, stocks, commodities, you didn't just survive inflation, you captured it. Because asset prices inflate too. In fact, they inflate first and they inflate faster. This is the transfer. Money moved from people who hold cash to people who hold assets, from renters to landlords, from savers to borrowers, from wage earners to wealth owners. It wasn't announced, there was no vote, it just happened automatically embedded in how the monetary system responds to inflation. Let's put numbers on it. The median home price in the US increased by about 45% between 2020 and 2023. If you owned a home, your net worth jumped by 6 figures on average without you doing anything. If you were trying to buy a home, you just got priced out of a market you could have entered 3 years earlier. Same person, same income. Wildly different outcomes based purely on timing and asset ownership. Stocks followed a similar pattern. The S&P 500 is up over 50% from pre-pandemic levels, even after corrections. If you had a brokerage account, a retirement fund, stock options, you rode that wave. If you didn't, you watched from the sidelines while your grocery bill climbed. This creates a strange irony. The government injected trillions into the economy, ostensibly to help people weather a crisis. And it did help in the short term. Stimulus checks, expanded unemployment, rent freezes. But the long-term effect was a massive transfer upward. Because the people who benefited most from all that new money weren't the ones who got a $1,200 check.
I see.
They were the ones who owned things when the money supply expanded. There's a term for this in economics, the Cantillon effect. It describes how new money doesn't spread evenly through an economy. It enters at specific points. Banks, financial institutions, asset markets, and the people closest to those entry points benefit first and most. By the time that money trickles down to wages and consumer prices, its value has already been diluted. The wealth transfer has already occurred. This isn't a new phenomenon. It's happened in every major inflationary period in modern history. Weimar Germany, 1970s, America, post-Soviet Russia. The pattern is consistent. Inflation punishes people whose wealth is in currency and rewards people whose wealth is in property and equity. What makes this moment different is the scale and the speed. We compressed a decade of monetary expansion into 2 years. The wealth gap didn't widen gradually. It lurched.
I see it
The
now.
home ownership rate among young adults dropped to historic lows while the
money is
average
growing.
homeowner
But
saw their
how?
net
I
worth
don't get it.
spike.
Reinvesting.
Asset
Watch
prices
it grow.
decoupled from incomes faster than any period since the 1920s. And here's the uncomfortable part. Most of this wasn't accidental. Central banks knew this would happen. When the Federal Reserve drops interest rates to zero and buys trillions in bonds, they know asset prices will rise. That's the mechanism. The goal is to create a wealth effect, make people feel richer so they spend more and stimulate the economy. But that only works if you own assets to begin with. If you don't, you're not stimulated, you're subsidizing. Now you might be thinking, okay, but inflation's coming down now, prices are stabilizing. Doesn't that fix the problem? Not exactly. Because the transfer already happened.
All
The
right,
wealth
let's build this
that
up.
moved from
You
cash
got it,
to
boss.
assets didn't move
Perfect.
back
Keep
when
it steady.
inflation cooled.
On it.
Asset owners locked in their gains. The renter who couldn't afford a house in 2021 still can't afford it in 2024 because prices didn't fall. They just stopped rising as fast. This is the asymmetry. Wealth transfers upward during inflation, but when inflation stops, wealth doesn't transfer back down. It stays concentrated, the gap widens in one direction only. So what does this mean going forward? It means we're living in an economy where the most important financial decision you can make is not what job you have or how hard you work. It's whether you own assets or not. And increasingly, whether you can afford to own assets is determined by whether you already own assets. It's a closing loop. Generational wealth isn't just about inheritance anymore, it's about whether your parents owned a home during a period of monetary expansion, whether you had access to capital markets before asset prices inflated out of reach. Some people call this a crisis of affordability.